The hardest thing in the world to understand is the income tax. Albert Einstein. But whether or not you understand tax, one thing's for sure, you must pay the tax man. How much you owe is where the question lies. Now, the 1% of the world that's ultra rich have the best accountants to make sure they pay as little taxes as possible. It's the rest of the regular 9 to 5 working population making under $400,000 a year that shoulders the greatest tax burden. If you're part of the 99%, this video is for you. Welcome back to Tax Premier. I'm your host, Johnathan Wood, where we dive into everything finance and help you pay the least amount of taxes possible. In this video, we take an inside look into 10 IRS tax secrets and loopholes to help you pay little to no tax on most of your money. So if you like the video, subscribe if you haven't, and let's jump right in. So number one is retirement savings. The goal is not just to retire from your job, but to actually have something to retire to. And here's where retirement plans come in. They allow you to make contributions directly from your income to invest in low-risk assets for retirement. Then once you attain the retirement age of 59 and a half years, you can start taking penalty-free withdrawals. Now, before you consider anything else, you want to take advantage of the retirement plans offered in your workplace. The most common ones are 401ks and 403bs. The 401k is available to those working for profit employers, while the 403k is for employees working for nonprofit and most government organizations. Now in 2024, the contribution limit for 401ks, 403bs is $23,000 spread across the year, which is $500 up from 2023. The magic, however, is in the tax benefits. Your contributions are deducted from your income before tax is applied, therefore lowering your tax bill for the year. You won't pay any taxes on that income until you start making withdrawals when you retire. So imagine if you start saving in your 20s or 30s, that's decades worth of tax-free growth. Number two is traditional IRA. Now, you're probably asking yourself, what if I want to save more than my workplace retirement contribution limit? Granted, not everyone is in the same tax bracket, and for some people, $23,000 a year doesn't fully meet their retirement saving goal. So in addition to your employer offered plan, you can contribute to a traditional individual retirement account or IRA. And depending on your unique financial situation, you may actually qualify for tax deductions for contributing to a traditional IRA. Number three is pre-tax commuter benefits. Now, did you know you could save on taxes by deducting your commuting expenses from your tax return for the year? Despite how relatively simple this tax benefit is, most people do not know or take advantage of this loophole. So exactly how does it work? Pre-tax commuter benefits are offered in almost every workplace. For 2024, you can spend up to $315 a month on commuting and not having to pay a dime on taxes for that part of your income. Number three is pre-tax commuter benefits. Now, did you know you can save on taxes by deducting your commuting expenses from your tax returns for the year? Despite how relatively simple this tax benefit is, most people don't know or take advantage of this tax loophole. So exactly how does it work? Pre-tax commuter benefits are offered in almost every workplace. So for 2024, you can spend up to $315 a month on commuting and not have to pay a dime of taxes for that part of your income. Now, this might not seem as much at first, but in a year, it adds up to $3,780 a year. Now, the good news is that this benefit covers transit, whether you're taking a train, bus, subway, or ride share, and parking if you drive to work. So definitely take advantage of this. Number four is long-term capital gains. Now, capital gains is a general term used for describing the profit you make from selling an asset. For instance, if you buy a stock at $300 and sell it at $400, you made $100 in capital gains. The vice versa is also true for capital losses. Capital gains can either be short-term or long-term. Basically, if you hold your gains for a year or less, it's considered short-term. And if you wait for longer than a year to sell, it's long-term. So why does this matter when we're talking about taxes? Now, long-term capital gains are taxed at a lower rate than short-term gains. To be more specific, long-term gains are taxed at a rate between 0 to 20%, depending on your taxable income, while short-term gains are regularly classified as regular income, subject from anywhere from 10 to 37% tax. In this case, patience does really matter. Number 5 is capital losses. Now, all kind of investing in from stocks to real estate is risky. That means you can either make a capital gain or loss when you sell your investment. Now, capital losses do suck, but if you lost from, say, investing in a stock or even for crypto this year, make sure you report them on your tax returns, because while capital losses are bad for your portfolio, they're good when it comes to taxes as they actually reduce your tax obligation. Basically, losses count as a tax deduction. It's also worth mentioning that with stocks, you're given Form 1099-B, which is where you're supposed to report your stock losses. But from some other type of investments like crypto, you don't get this form, which means losses often go unreported. Now, if you don't report, however, you're basically just throwing money away. Number 6 is health savings account. Now, an unexpected medical emergency can happen when you least expect it, and an emergency room visit can cost anywhere between $2,400 to $2,600. Unfortunately, about 57% of Americans can't afford a $1,000 emergency cost. This alone should be enough motivation to open a health savings account or HSA, but if it's not, then consider the tax benefits. HSA is a savings account that allows you to set aside some pre-tax income for your health-related costs. The best part is that you can withdraw this money tax-free for qualified medical expenses such as deductibles, co-insurance, and co-payments. And when you're not using this money, you can invest it and earn tax-free interest. Now, to establish the HSA account, you need to be enrolled in a qualified high-deductible health plan, otherwise known as a HDHP. Number 7 is Section 1202 Gain Exclusion. Now, the investment world is no doubt diverse, and so your goals and preferences should guide the kind of investments you choose to put your money in. Now, suppose one of your goals is to save as much taxes as legitimately possible. In that case, you might want to consider investing in a qualified small business corporation, which can be an LLC, a corporation, or C Corp. Then you can enjoy what's known as a gain exclusion, a little known tax loophole investors have been capitalizing on for over 3 decades. Now, all you need to do is invest in a qualified business. It doesn't really matter how much, then hold that stock for at least 5 years. Now, when you decide to sell after this and make a tidy profit, you pocket it all tax free. Now, you can also set up a business structure or a qualified corporation or LLC. Now, after 5 years, the profit on that is 0 taxes. However, keep in mind that the gains must be below $10 million in both cases. The mind-blowing thing is that lots of investors and business owners qualify for this benefit but don't even know about it. Number 8 is primary residence exclusion. Whether you're a homeowner or planning to be one soon, you want to pay close attention to this tax secret. If you buy a home and later decide to sell it for profit, you can save on taxes up to $250,000 of your gains if filing your taxes alone, or $500,000 if you file jointly as a married couple. So if you bought a home at $500,000 and decide to sell it for $850,000 a couple years down the line, you only have to pay tax on $100,000 of the $350,000 in profit. However, you have to qualify for this benefit, and here's how you qualify. You must have used the home as your primary residence in the last 5 years of owning it. The good news is that period doesn't have to be consecutive. Number 9 is margin interest. Now, we talked about deducting losses you accrue from your investments. However, did you know that your investment interest expense is also deductible? Now, margin investing is basically a type of loan you take from your investment broker to buy stocks, bonds, and other assets. As with any other loan, buying market securities on the margin means that you have to pay not just the amount borrowed, but interest as well. Now, the interest can be deducted from your reported income, therefore reducing your tax bill. Now, number 10 is minimal rental use rule. Listing homes for short-term stay renting is one of the most popular side hustles today. With online platforms like Airbnb and Bookings.com, it's easy to start leasing part of your entire home to domestic as well as international guests. The good news is that the government won't take a chunk of your income unless you meet specific threshold. That's right, if you rented out your property 14 days or less, then you won't owe the IRS any tax on that income made. So apply these secrets and see how much you'll save this year in taxes. If you have any additional tax loopholes, share them in the comments below. And that brings us to the end of our list. For more practical finance tips just like these, make sure you subscribe and turn on your notifications. If you'd like to book a call with my team, click the link on my channel to schedule a free tax analysis today as well. Until next time, see you on the next one.